Hey guys, welcome to today's class. Today's class is going to be a strategy class on volatility. So, what is volatility? Volatility in trading measures is how much and how quickly an asset's price moves over time. Basically, if I were to put it into my own words, is how big it goes up and down and how fast it does it. So, for example, high volatility, you see these crazy swings, and it's a lot higher risk, but you also get like higher rewards. Low volatility, it's slower movement. It looks a little bit more like stable, but it's lower risk and you get lower rewards, obviously. So why does it matter? Well, depending on your volatility, you can identify opportunities and manage your risks. So, for example, sometimes some people don't like to trade in high volatility because they could lose a lot of money pretty quick. Some people don't like to trade in low volatility because they won't make any money. Um, or if they do, it'll be like barely anything and it'll take a lot longer. Um, so, like, basically, that's what it is. And then the VIX volatility index is a tool that most trading apps have that show you the market's volatility, so that you could like kind of be able to tell what you're looking at for the day, and trade accordingly.
All right, so what do we want to do when there's high volatility in the markets? How do we want to trade this? So first of all, I want to start by saying when there's high volatility in the markets, if you know how to trade well, you'll make way more money than you usually would by just trading with low volatility. All right, so here's some strategies that we like to follow in Lux to be able to be successful, safe, and smart on a high volatility day. So first of all, we want to look at scalping and just quicker trades. So instead of looking for those longer movements like big swing trades, I often look for just scalps on high volatility days because you can make a lot of money. It can be a lot safer. So let's say it's a very high volatility day and I find a double top and I want to take puts. So I'll take quick puts and it can be a 30-second trade. I just get a bounce because the volatility is quick. We bounce 20 cents or something good. I get in, I get out. It's safe. I take advantage of the high volatility. Number two is option selling. When there's high IV, so that is a term that you base volatility off of, it means expensive options, so selling them can be profitable when it's very volatile. Another thing is volatility breakout trading. So enter price when it's at a key level. So if trade gets to a very key level, price gets to a very key level, say double bottom or area of support, I might enter there because the bounces that we often see on almost every day can be way more volatile, way bigger, and you can make way more money, especially when we have breakouts. Like today, for example, trading. When we had a breakout, we dropped like what, $10 or something crazy. Emmanuel made $800. It was crazy just off of a breakout. That's how we had that high volatility plus a breakout, and we made it very successful. Another thing is stop loss management. This is a debated topic a lot for high volatility days, but use a bigger stop loss. And the reason for this is because think about a chart when it's very volatile. You're bouncing all over the place. And if you have a trade setup, let's say double top and I'm going to take puts. If price bounces really quickly up, it can do that and still come back down. That's just how the volatility is going to work. It's very rigid. It's not smooth. It's not easily predictable day. So that's why a lot of times people use their normal stop losses on a high volatility day and get stopped out every single time because price is just sweeping. So that's why it's smart to widen the stop loss on a high volatility day. Some people believe it's not smart because high volatility days can go either way, and it might keep going in your way and you might lose more money. Some people believe that you should stop it short, but yes, it is true. Make your stop losses bigger so you can have wicks, so you can have retests that are very volatile and still win your trade. So the last one that we have here is hedge positions. Use options or inverses. All right, next. How do we want to trade with low volatility? All right, so let's see. Instead of high volatility, it's about the opposite, if you just want to think about it that way. So low volatility, we want to follow a trend. We want to follow our market structure. So think about it this way. When it's very high volatility, I'm looking for quick price movements. When it's low volatility, I'm looking for an overall market trend. Okay, so essentially I'm just trend following often. Not all the time, of course, but let's say we're trend following. We have an uptrend for the day, good market structure. I enter market structure. I can ride this for an hour, 2 hours. Same thing, range trading. So we'll buy at support and sell a lot at a later time after price has already made a big move. And it can take a lot of time to do that. Instead of on a low volatility day, you're probably not looking for scalps because those scalps will make you a lot of money and they higher risk, right? Okay. So cheaper options can be profitable if volatility starts to spike up, obviously. And then we also have dividends, which we're not really talking about right now, and tighter stop losses. So as opposed to having high volatility and wider stop losses, making your stop losses tighter when there's low volatility makes more sense because things are more confirmed, right? So what I mean when I say more confirmed is if price breaks below a trend line when there's low volatility, it has a greater likelihood to continue that trend after it's broken, where in high volatility, it can spike down and go back up. So just think tighter stop losses when low, greater stop losses when volatility is high. And I guess you're just trading for longer periods of time versus shorter periods of time. You can trade on low volatility all the time and be very successful, but if you are able to trade with high volatility, you can make a lot of money. I will say another thing, low volatility is a lot safer. It's a lot easier to trade if you're new to trading. Low volatility is the way to go. Find a low volatile stock or trade during hours where volatility is low because high volatility is not easy to trade. All right, Manuel, what you got next?
All right, so I'm going to show you guys some examples of high and low volatility. So like, for example, recently we've had pretty high volatility in the market. You guys can already see it right here. So like you see these crazy spikes up and down. So it's like 593, for example, look, 596 up here, all the way down to 593.90, 595, all the way down to basically almost 592. Like these are crazy movements, you know what I'm saying? And it looks like spikes. It looks scary. Like, it looks like if you were to touch it, you could like start bleeding out of your finger or something. That's high volatility. But for example, when we go into the nighttime, and this could happen in the day, but sometimes it's easier to see in the nighttime. Right here, this is what we would call extremely low volatility. You see like this very stable kind of like up and down movement within this certain range, where it's like sometimes it's not even within a range, but it's like you could see the pattern of it. That's low volatility. Let me see if I can find some examples of low volatility. This right here is kind of low volatility right here. So like we have this downward movement, but it's nowhere near, those crazy spikes that we were looking at 30 seconds ago. Like these movements right here, you can easily chart out and like, make, here, actually, let me try to draw these trend lines for you guys real quick. You could easily draw like, a flag with this and be like, okay, yeah, no, like I could tell, it's staying in this range and it's going to just keep doing this for a minute and it's slow. And like, it's pretty simple. Like you could buy puts up here, hold it for like Sam said, maybe even a couple hours and maybe make some profit if like data isn't too crazy. But like, for example, earlier that same day, this right here is extremely high volatility. This is a sell-off. So this is like people get scared. Everybody starts selling. And then usually when everybody sells, there's also a buy up, buy up just as strong. But for example, this right here, this is high volatility. This is where you can make a lot of money. You could also lose a lot of money. So like, for example, say this morning, somebody hops in right here, they're thinking, it might be like a green day, or they're thinking it might not be that volatile. They think it's like, here, let me show you. They think the trend for today is looking a lot more stable, and it looks like, we might just be moving in this certain direction. As soon as this high volatility starts to hit right here, boom, you lost most of your money, or you gained a whole bunch of money. So that's basically the difference between the two. Hope it was easy to understand, but yeah, that's gonna be it for today, guys. If you guys are watching this video late or whatever, make sure, like I always say, take notes. That's the most important thing, is to take notes. And yeah, just keep doing what you do. Some people prefer high volatility, some people prefer low volatility. Find what works best for you and stick to it, because at the end of the day, trading is all about being consistent. And Maybe you can master both of them. You try to master one before you try to get into, the other one, with the same amount of energy, because, like I said, consistency overvalues everything. But yeah, I hope you guys have a good rest of your day, and we'll see you later.